big move by the Federal Reserve, raising interest rates by 0.75%. That's the biggest hike in nearly 3 decades. It's to help fight inflation, but the move is also triggering fears of possible side effects, an economic slowdown, or worse, even a recession. Our chief business correspondent, Rebecca Jarvis, is tracking the latest.
Mounting fears of a recession as the Federal Reserve hikes interest rates 0.75%, the largest increase in nearly 3 decades.
High inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation.
With food costs up nearly 12%, gasoline up nearly 50%, and airfares soaring nearly 40% from a year ago.
I'm probably spending a good $50 to $75 more a week on groceries.
With so much of family budgets going to necessities like gas, Americans are starting to cut back. Retail sales falling 0.3% in May.
There is a lot of economic uncertainty right now. I think it would be wise to be looking at how much money you're bringing in, how much money do you have saved, and do you have money set aside for a rainy day?
The Fed's aggressive rate hike, meant to help stabilize prices, will also make it more expensive to borrow money. Everything from car loans to mortgages, which have already climbed from 3% in January to 6% now, to credit cards. In real terms, that means if you're carrying a balance of $5,000 on the average credit card, making minimum payments, you'll have to pay an additional $289 in interest because of this rate hike.
With interest rates rising, it's a good idea to pay down those credit cards if you're in a position to do so, particularly because the Fed is expected to continue hiking interest rates into the rest of this year. And when you look at the economic picture, there is now a 72% risk, according to economists, that we will be in a recession by early 2024. Phil?
Rebecca Jarvis, thank you. And we want to continue on with what Rebecca was just talking about. I want to bring in business reporter Alexis Christoforous. She joins me now with more. I want to talk about what Rebecca was just talking about. How far is the Fed prepared to go here? Because this is one of those really complex double-edged swords. People are feeling the pinch of inflation. Now, interest rates are going to go up, making it harder for people to pay credit cards, their mortgages, and things like that.
Yeah, well, you just laid it out. And, you know, yesterday during his press conference, Fed Chair Jay Powell made it very clear under no uncertain terms that the Fed is there. They've got the economy's back. They're going to do whatever it takes to bring these prices down from their 40-year highs. Now, between now and the end of the year, there are 4 more interest rate meetings from the Federal Reserve. At each of those meetings, they are expected to raise interest rates. Cumulatively, we're looking at rates going up another 1.75% to possibly 2% by the end of this year.
Those are huge numbers.
Yeah.
And people will struggle then to get mortgages. There are a lot of people sitting right now with 3%. On their mortgages, and then their credit card bills, they'll start seeing money coming, you know, they have to pay money every month on just interest charges.
Those bills will go up. Yeah.
Those bills are going to go up too. Everybody's going to be paying more. Talk about this, because this is like this is a risky venture to continuously raise interest rates, because what you're doing is trying to push, you know, tamp inflation down, but you go too far, you have a recession. How does that work?
Yeah, you're exactly right. And we've seen this throughout history. There have been times when the Fed has had to aggressively raise interest rates, and sometimes that does result in a recession. Not all the time, but sometimes. And so what the Fed's trying to do here is achieve what they call a soft landing as opposed to a hard landing. They want to bring demand down just enough to have businesses pull back a little bit. As a result, by the way, Phil, you're probably going to see the unemployment rate rise because businesses will have to make adjustments. So the unemployment rate's going to rise a little bit. The Fed's okay with that. They're saying that needs to happen in order to bring the economy in line and to bring these prices down. If they tip us too much one way, we could indeed fall into a recession, which, by the way, the textbook definition is 2 quarters or 6 months of declining economic growth.
Okay, and so it's a tipping point. Is there an equation, or is it different with every economy? I mean, how do they know they're going too far? How do we know they're going too far? It's a scary prospect.
It's a little bit of a loosey-goosey definition. I mean, they say it's 2 quarters of declining growth. I mean, talk to the average American who's, you know, having to take a lot of money out of their budget every month for just the necessities like groceries and gas, and they might actually say, we're in a recession right now. A lot of the time, we don't know we're in a recession till we're almost out of it. And in fact, I spoke to an economist yesterday yesterday after all this, and he said, I wouldn't be surprised if we fall into a mild recession in the next year or so, and then the Federal Reserve may start raising interest rates again to sort of goose the economy by about a year from now. So, you know, it is.
And this just means people are going to be paying more for groceries and credit cards, interest rates, and everything.
For the time being, yeah.
Okay. Well, this isn't just an American problem, right? We're seeing the effects globally.
For sure. You know, inflation is not just a U.S. issue. The supply chain issues, COVID, I mean, the global pandemic, the war in Ukraine, high energy costs affecting everyone around the world. And so yesterday, the Fed made its aggressive move. Today, the Bank of England raised its short-term interest rates by 0.25%. They're being a little more conservative. And the European Central Bank expected to raise rates in July and then again in September.
The definition of misery loves company, I guess.
I think you're right.
Stocks rallied yesterday on the Fed announcement, but what's happening this morning?
Oh, that was a very short-lived Fed rally. It faded really quick. I think investors had a night to think about it, and they're looking at sort of what is the benefit to what the Fed is doing and what's the risk analysis. And there is still fear out there that the Fed's going to go too far too fast and push us into a recession.
All right, Alexis, thanks so much. As usual, always good to see you in studio and to have your expertise.
Thanks.
Hi, everyone. George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel. And don't forget to download the ABC News app for breaking news alerts. Thanks for watching.